Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. Thanks for joining us today. We're excited to have you. I'm your host, Josh Knoll, alongside co-host Michelle Lee Melton, the Cher to my Sonny, the Simon to my Garfunkel. Michelle, how you doing?
Frazzled.
A little frazzled, huh?
Yeah.
It's been a day.
Yeah.
Well, we're about to make your day a lot better. We're going to be talking about money and bips and mills and all kinds of neat things. So here we are once again, Coastal College's recording studio, beautiful downtown Fairhope, hatching up another great show for those of you tuning in. So listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. You're listening to what we consider Lower Alabama's most dynamic financial radio show. And what do I mean by that? So here's what we got in store for you today. First segment, deep dive on our topic of the day. Second segment, at about 20 minutes past the hour, fan favorite, Michelle with the news of the week. Third segment, roughly 40 minutes past the hour, Josh's crystal ball and
Josh's big mouth.
That's right, big mouth. So buckle up. We got a lot to get to. Quick background on me, again, for those of you new to the show. My name is Josh Knoll. I am a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope and Orange Beach, Alabama. You can find more information on me and the rest of the team at Gulf Coast Financial Advisors by visiting our website. That's gulfcoastfa.com. Gulf like the Gulf of Mexico, Coast, FAs, and financialadvisor.com. Or you can always give us a call at 251-327-2124. Now, if you just missed that, do not worry. We'll repeat our contact info several times throughout this show. All right, so our topic today is going to be trying to help investors answer this common question. It's a question that gets asked a lot, I think. Should you manage your own money? Should you manage your own investments? It's a totally valid question. Again, it does get asked a lot, particularly by those of you in or near retirement. But before we answer that question, what I want to do is lay some groundwork with a history lesson, something along the lines of, do you remember Paul Harvey?
Oh, yeah.
Yeah, Paul Harvey's.
Now the rest of the story.
Now you know the rest of the story. And Michelle and I love history. So we're going to start this way with our history lesson that leads into what our topic of the day. Michelle.
Yes.
Have you ever wondered why gas stations price their gas with the extra 9 at the end of the per gallon price?
Well, I admit that I know that. I know why.
I figured you did.
It has to do with millage rates.
It's millage rates. So, for example, for those of y'all not familiar with the question I just asked, when you pass a gas station, you'll see $3.49 and then like a 9/10 instead of just saying straight out $3.50, right? There'll be a 3.499 or something along that lines. So that extra 9, and Michelle just referred to it as millage rate because she's familiar with it, and her real job, not the million she makes from this show, in property tax assessments and things like that. It's a nod to a long overlooked unit of currency measurement. It's called a mill.
Or a milla.
Yeah.
Like Lil Wayne.
Well, so simply put, a mill is 1/10 of a penny, or 10% of a penny. And I think the origins of its use, the mill's use, is pretty interesting. I mean, at least to me. So would you like to learn that history?
Sure, yes.
Okay, here we go. The official recognition of the mill, M-I-L-L, dates back to the Coinage Act of 1792, just
1792, people.
Right, which standardized the United States currency. And according to my research, it became part of gasoline's pricing structure, we referenced that earlier, when the Revenue Tax Act of 1932 was passed, which established a federal excise tax on gasoline of 1/10 of 1 cent, or
1 mil.
There you go. Now, I know there's marketing philosophy at play here too. That is, it's been proven that people will buy more stuff if it appears cheaper. Say the difference between a $9.99 bottle of wine and a $10 bottle of wine, right? Kind of silly, but
that is silly.
But it's been proven. All right, so listeners, you may be asking, just like Michelle is right now, what in the world does 1/10 of a penny
have to do with the price of tea in China?
Have to do with anything. Have to do with our topic of the day of whether you should manage your own investments or not. Yeah, and let me tell you something. It matters a lot. It particularly in helping me set the stage for you understanding something related to the basic fractional math of a mill.
Word salad.
Something that is a major factor in the cost and sometimes the success of your investment strategy. Bear with me here. As we discussed, you will see that mill denominations and gas prices, property tax assessments, even stock issuing of stock, sometimes electrical bills. I've never checked mine that close, to be honest with you, but I know that they're sometimes on there. But did you know, listeners, that in the investment world, we have our own terminology for fractions of a fraction? Well, you will now. Today, we're going to discuss what my industry calls basis points, something that is usually abbreviated to BPS. That would be B as in boy, P as in Peter, S as in Sam, commonly referred to as bips, which you'll hear us talking about bips. A basis point or a bip is 1/100th of 1%, or for you math nerds out there, 0.01%. So it's not exactly the same percentage as a mil, but just like a mil, it's a fraction of a fraction. And also, just as the mil is still very much a part of our everyday purchasing decisions, basis points are very much a factor in nearly every investment that you make, whether you knew it or not. Mutual funds, bonds, ETFs, etc. In these cases, bips are used to be specific with price changes of an investment. Like with bonds, you'll see a detailed out to the mil. But we're going to set that part of the use of mil to the side for now. We're going to talk about a different use of bips. Pardon, I said mil, but for bips, basis points. There's another use of basis points that has a more direct impact to you investors than the price changes in investments, and it's related to the fees that you're paying in your investments, plus the fees you're paying if you have someone that helps you manage your investments. These are the fees that you investors have been paying for years. And I'm going to be honest with you, sometimes we see this a lot. You might even have an investment strategy that is infested with too many bips. You got bips all over the place and you don't even know it.
Bed bug bips.
Now, to be fair, so as the old saying goes, Michelle, there's no such thing as a free lunch, and that applies to your investments. Whether you all are just a do-it-yourselfer paying 6 bips, and that what would be 6 bips, Michelle, would be 0.06
yes,
of 1%
yes.
on low-cost index funds. Or let's say you're on the other end of the spectrum, you're a variable annuity customer, a VA user that's paying over 300 basis points.
Ouch.
Again, probably you didn't realize this. One way or the other, you're paying someone a certain amount to invest your money. The question becomes, are you getting what you paid for? So with all that groundwork laid, let's go back to our original question. Should you manage your own money? Well, the only way to answer that question as accurately as possible is to determine what is important to you as an investor, what additional services you want or need, and how much experience do you have maybe managing your own investments or not. And most importantly, and the reason for the history lesson is, the goal of all this is to try to find the sweet spot of your individual investment requirements and meets up perfectly with just how many of those bips that you're willing to spend to accomplish your goals, okay? We on track here? You with me, Michelle?
Sort of.
Sort of. Well, we're going to keep going because this is important. It really comes down to expenses in someone's investment portfolio. And these are one of those terminologies that's used in my line of work. And I think sometimes it's used so people don't look too much deeper because they get confused. Well, bips, all that.
Bips, I know. It sounds made up. And then I think of Biff from Back to the Future.
Back to the Future.
That's right.
That's good. I'm going to make like a tree and leaf.
That's right.
All right. So from my experience, generally speaking, when someone wants to manage their own money, it's typically because they have some experience and hopefully even some success buying and selling things such as stocks or bonds, mutual funds, ETFs. And we've had people walk in that even have some experience with more advanced trading techniques such as calls and puts, short selling, or derivatives. And for these kind of folks, I'm going to say in general, I say have at it. You know, when it comes to the question of should you manage your own money. If you know how to do it yourself, and you've got the time and you've got the bandwidth to handle all that work, you're never going to be happy paying someone else to do what you can do on your own. For example, people that know how to do, we have friends, Corey and Sean, they know how to do all the things of a house remodel, right?
Right.
There's no way they would ever be happy paying somebody.
No, and they won't.
In fact, they would drive that person nuts.
Yes, they will.
Right.
And have.
Exactly. And the same thing applies to investors. If you got that experience and the bandwidth, then do it. Now, for the rest of you, maybe you've managed your own investments a little, maybe not at all. But as you're preparing for retirement or possibly in retirement, you're trying to watch every dollar you can, and you're just not sure how much value you would get by bringing in professional guidance. And then, of course, you add to that the trust factor that happens with my industry, the high-pressure sales techniques, things like that. And you can kind of see why so many people consider just managing their own investments. So the main thing, as you can see, it's a very individual, it's a very personal question. To help you answer that question for yourself, we're going to discuss both the cost of managing your own investments versus getting paid professional help. And we're also going to talk about the value that some financial professionals can bring to the table, including, obviously, our own firm, Gulf Coast Financial Advisors. So let's do this. Let's get back to the bips. We're going to discuss the pros of managing your own investments. As we mentioned earlier, there's just tons of low-cost index funds out there that only cost a fraction of 1%. In fact, I did a little research. Fidelity has one advertised at just 15 bips, which is, again, 0.015 of 1%. That's a bip, right? Mm-hmm. And there's probably even cheaper options than that. So even if you decide to use more expensive, actively managed mutual funds, something maybe charging 50 bips, maybe 100 bips, which would be 1%, you're still cutting out the middleman broker or advisor. So not only are you eliminating some fees, but you also don't have to worry about conflicts of interest. You should have your own self-interest in mind more than anyone else. And you get to avoid, like I mentioned earlier, you get to avoid high-pressure sales pitches, which, as Michelle and
drives Josh crazy.
Drives me nuts. And to be fair, there's also been research that many active investment professionals fail to outperform even passive investments.
That's
right?
So sad.
It happens, right? So staying with the cost side of the debate, then I just gave you the pros. What's the downside? All right, so obviously getting caught in a huge down market, like happened in March of 2021, or 2008, or 2001, or not. You get the idea?
Yes.
It happens, right? Having huge losses in your portfolio can and will have a huge impact on your retirement dreams. Trust me, seen it. Or let's say this, maybe the market in general it's not a 2008 or a 2021. Maybe the market in general is doing fine, but you just happen to pick a real dog of a stock or a fund. I feel you day traders nodding your head. Maybe you believed in a position so much that you went all in, right? You get the idea. Those are kind of things that can really be a huge risk to your retirement planning. So you all that have bought your own stocks and bonds and things like that, you would probably ask me right now, well, okay, fine, Josh, but wouldn't I run the same risk if I had someone investing for me? Possibly. You wouldn't be wrong, except here's the thing. There's going to be particular instances where you're ignoring the value of having an experienced financial professional help you if you're too focused on the cost, because what we're going to describe today to you all is it's more than just about the bips. It's more than just about the stock picking and the bond picking and the fund picking. It's more than just about the ups and the downs in the market. A lot of it is going to come down to, yes, you got to pay attention to the costs, because it's not uncommon, Michelle, for somebody to come in with their portfolio and we look through it, and like I joked earlier, it's infested with bips. What I consider an inappropriately high fee for maybe not a ton of value, not a lot of robust services. So we're going to do this. We're going to talk about value. What do I mean by that?
Whatever do you mean by value?
Here's what I mean. For those of you in or near retirement, this is probably as important or more important than the cost side of it. See, listen, remember, there's nothing wrong with paying someone to simply handle your investments for you. Again, maybe you're not comfortable doing it yourself, or maybe you've had a good run with a broker or someone you trust recommended someone. Fine. But when you're talking about simply the investment management and you're just using a broker to help you pick and choose stocks or bonds or mutual funds or ETFs, your broker's role is simply to pick and choose those investments based on your risk tolerance and time horizon. Sometimes even more simple than that, because it's transactional in nature. You just told them, hey, just do better than I would do on my own. But what a lot of y'all don't realize, because maybe you haven't checked in with how the industry has changed over the last, call it 5 to 10 years, been dramatic change in our industry. There's so much more available to most investors in today's financial advisory world. On top of the investment management piece, which was most people would recognize the broker side of it, there's financial planning, there's tax planning, there's estate planning, like Michelle would be familiar with, right? There's wills and trusts, there's income planning. The list goes on and on. So when you asking the question about how much someone's financial guidance is going to cost you, especially if they spout out the word it's 50 bips or 75 bips, now you know what they're talking about. That's a good starting point. But an even better question is figure out how much value do they bring to the table for that cost, okay? So let's talk about some of the things that we do quickly, Michelle. We do charge a fee for our service for managing assets, for raw investment management. And we are going to quote that fee either in percentage or in bips. And for those of you who listen to the show, if you hear the BIP word, now you know exactly what we're talking about when we throw it at you. But the investment management part of it is just one piece. On top of those services, depending on the level of involvement that the client wants in their life, we also do comprehensive financial planning. We do the tax planning. We do customized income plans. We have quarterly, semi-monthly, and annual meetings. A lot of times we will coordinate with your other financial professionals, particularly your CPA. And there's a lot of value packed into the fees that you pay when we do these things. Now, for some clients, we're going to work on that in a separate arrangement. We'll talk more about pricing structure in our Michelle with the News of the Week, because we're going to lay out how guys and gals like me are paid. But for a lot of our clients, that's going to be all in a wrap fee that we're going to provide these services, because we're trying to give them the most bang for the buck that they can get. So, all right. Any questions on any of that?
Oh, I got it all.
All right, the millage rate.
Full absorption.
Full absorption. Millage rate, you brought some stats on that?
I did.
Yes.
I'm looking at the municipalities in Baldwin County, and the fairest of the fair, Fairhope, has one of the highest.
Oh, imagine that.
And school tax, the Fairhope school tax is 0.046.
All right.
It looks like Daphne's that way too, and Spanish Fort.
Well, Fairhopes must be working, because they recently had 4 students
get
a
sure
perfect
did.
score on their
One of them's a
ACT.
spawn.
And one of them just happens to be my son, Peyton Null. So there's a little shout out there. All right. So folks, wrapping up this segment, that's a list of some of the things we do. And if you want to have a no pressure, free, no obligation conversation with us, why don't you reach out to us? You can do it a couple different ways. If you want to call 251-327-2124. Or if you want to go on our website, you can find more information about us. Plus, in the upper right-hand corner is a link to our calendar. The website is gulfcoastfa.com. That's GULF, like the Gulf of Mexico, coast, like the name in the show title, FA as in financialadvisor.com. So again, gulfcoastfa.com or 251-327-2124. All right, folks, coming up next, every week Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Why don't you join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Don't turn that dial. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, coast, FA as in financialadvisor.com. Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week Michelle and I scour the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Now, our job is to help you all understand how these headlines impact you, especially when it comes to your money. So, without further ado, here's Michelle with the News of the Week.
All right, Josh, let's get started with one of the show favorites, Investopedia.
That's right.
They have an article titled Advisor Fee, What It Means, How It Works, Types. This article goes into depth into the different ways guys and gals in your industry are compensated, including something called AUM, which I learned stands for Assets Under Management, and not Auburn University at Montgomery. So it also talked about something called robo-advisors, which sounds very apocalyptic to me.
That's good.
It's frightening. Okay, anyway, apparently one robo-advisor called Betterment, capital B and MENT at the end, has a standard investment management fee of 0.25%, which I know means 25.
That's 25 bips.
That's right. Basis points, a.k.a. bips.
Right.
I also learned that commissions on investments are called loads, which I find hilarious and can't say it without cracking up. So anyway, what I would like for you to explain to us in plain English is the mysterious ways and amounts people are in your industry are actually paid.
Well, because there is a lot of confusion to how we make money. I mean, I still get asked that a lot.
Bips.
Now, how do you make money? Well, yeah, I make it in bips, right? I make it in basis points. If you're just tuning into the show, we talked about mils, which are fractions of a penny, and how in my industry we have a thing called bips, basis points, which are a fraction of 1%. And it's a pretty common term across the industry, and that's how we're paid. So let's talk about, you asked, what's the different ways that people get paid? So first, Michelle, let's talk about the broad difference between an advisor and a broker on the investment side. Generally speaking, a broker coming up from the broker world, and most people honestly are going to be more familiar with the broker world if they've invested, say, 10, 15, 20 years ago.
Yeah, Wall Street.
We've all seen the movie Wall Street. Those are brokers. They carry Series 7, maybe some other licenses allow them to sell securities on a commission. Now, we won't get too far in Nerdville, but you can sell those securities. You can get an upfront commission for those brokers. You can get a commission at the back end if the position is sold. You can get paid a fee throughout. There's different classes of mutual funds. There's A, B, and C. Of course, there's different things on the stocks. But to be honest with you, I don't deal with the broker world that much anymore. I gave up all of my broker and broker-dealer affiliations several years ago. But even at that point, Michelle, most of the sales loads and things that I saw were up front, most of them. Now, I do know they had some where they would charge a level fee, and I can't remember the last time I saw somebody charging it on the back end. In fact, I think that's called Class B, and I think everybody was trying to move away from that for various reasons. Okay, yeah, B shares were the deferred back end load, but I don't recall those being very popular. I could be wrong. If you're in the industry and listening and I'm wrong, just let us know. That wouldn't be the first time. That's why I have a whole segment dedicated to my big mouth. So Now, switching over to the advisor side of it, the advisor side, by definition and by licensing, typically cannot draw a commission on selling of securities or investments. What they can do is derive a fee. Now, the industry in general, Michelle, is going to be set up in a fee structure that is on assets under management. And you made a point during the break. You were asking about wrap accounts.
Wrap accounts,
right.
Yes.
So wrap account,
W-R-A-P.
right? Yeah, not rapper like LL Cool J or anything like that. But yeah, wrap account is kind of the alternative to the broker relationship where you're paying a commission on transactions. A wrap account is more intended to position some type of steady and stable fee on the overall assets that the advisor is managing. For example, this is very simple math. In our industry, a common asset under management fee, or a wrap fee on AUM, assets under management, is 1% in general. So let's say you got $100,000 invested that somebody's managing for you in an AUM wrap fee account manner. They charge 1%. That's an annualized rate. So that would be $1,000. If you're paying that quarterly, you would see a charge somewhere in the neighborhood $250 per quarter. Now, the idea with that, in the broker world, Michelle, if somebody sells you a security and they get paid up front and then that's all they get paid, they're really not in lockstep with you typically if the thing goes up or down. Now, usually, a good broker doesn't want to get yelled at and sell you junk. He wants it to go up.
Sure.
Right? But with an advisor, the intent of the AUM fee is if you do better, the advisor does better. If you do worse,
everybody
the advisor
does better.
Right? And it eliminates a lot of the commission stuff. You and I talked about on the last episode, conflicts of interest. It doesn't, the accounts that I manage as a financial advisor, as a fee for service advisor, it doesn't matter if I pick security ABC or security XYZ. They don't pay me, the client pays me. So everything pays me the same.
Okay.
So it's not like where I've got a mutual fund that might pay a sales load of 5% versus a mutual fund that pays a load of 3%. Now you've got a conflict. Which one do you buy? Yada, yada. There's also your fee for service. You regular listeners heard me say that. A financial advisor typically, again, is going to charge a fee for assets under management. They can also typically charge a fee for service. That could be a financial planning fee, or they could be by the hour. Now, if you're an advisor that only charges for a flat fee for planning services or for hourly work, then typically you would refer to yourself as a fee-only financial advisor. This is going to be a really broad statement, and no offense to any of you fee-only guys that are listening, but more often than not, I see those men and women more in the planning only. They typically don't get into the investment management side as heavy. I know that's a really broad statement, but just for you, as you're all trying to figure out the difference between all of us, normally for those, they're going to leave the investment management piece up to someone else, and they're going to concentrate on the planning side of it. Nothing wrong with that. It's just the part of the industry where I came up on the investment management side. Then I started adding the planning fees. So I've got experience, so I keep those things in-house. So, all right. So that's a broad difference between brokers and advisors. It matters because, again,
Sure.
what is 5% commission sales load? That is, as we've learned, that's 500 bips, right? Versus maybe you can get a lot of service done for 50 bips over the course of a year. So good article. What's next?
Okay. Next up is Archaic U.S. News World and Report, because I'm pretty sure my grandfather read that.
That's been around. I feel like it's been around forever.
I feel like it's in some abandoned doctor's office, and I don't know if it really still exists. I mean, it does.
It's probably right there next to your Reader's Digest that you read all the time.
It might be, which is from my late and great grandparents, still catching up on that, and my prevention magazines.
You're keeping them in business.
Which I know. I learn a lot. Okay. So, their recent article is titled 10 Best Low-Cost Index Funds to Buy. As advertised, the article gives the basic details on 10 mutual funds and ETFs, making the case that index funds are great investment portfolio building blocks. The article goes on and quotes an analyst as saying, quote, "There aren't many things you can directly control as an investor, but the major exception is the fees you pay,"
right.
End quote, which falls in line with our conversation about investors paying attention to the bips associated with their investments. So, Josh, do you agree with the sentiment of this article? And can you explain what an index fund actually is? And there actually were some decent ones on here that required very little investment.
Well, yeah, so let's start with that then. Let's start with what is an index fund in broad terms. So on this, and very well known in the industry, Vanguard.
That's right.
Is listed on here. Vanguard, if any of you listeners there have heard of being a boglehead, they were kind of the pioneer, if you will, or at least the big push to really make low-cost index funds popular in the industry. They were definitely a catalyst of change. I don't think they were necessarily the first index funds, but they took it to a whole nother level. And their core thing, of course, there's Fidelity, there's Schwab on here. What they are, a low-cost index fund, when it refers to the index, here's what it's meaning. An index fund is going to, broadly, it's going to track not always a well-known index, but generally speaking, it's going to track an index. It's going to have the same holdings or similar holdings to what that index is, and they're going to try to at least keep up with that index. In some cases, they try to do a little bit better. What does that mean? Let's use the S&P 500, right?
Okay.
So they have an S&P 500 index. It's going to loosely try to have the same holdings, the same companies that the S&P 500 index has that you all see when you see the NASDAQ, you see S&P 500, you see these different market indexes, kind of gives you an idea of the overall health and trading volume of the stock markets, the various stock markets. The index is going to have those holdings in there, and it tries to keep the same weight among those holdings. What does that mean? For example, Apple has now closed, I think it's over $3 trillion in market cap. It's included in a lot of indexes. It has now become such a significant piece of the index. The indexes sometimes are referred to as overweight. They're too concentrated in one or a handful of companies. So one of the battles that these index funds have to do is they got to make sure that, hey, we may be holding positions in really, really expensive securities right now. And let's say that Apple, for whatever reason, just gets horrible, horrible news. And it goes from a $3 trillion valuation down to a $2 trillion valuation. And now it basically takes every index it's part of down with it. That's one of the dangers of being kind of blindly invested in some of these things, right? Now, the reason that they are able to keep the costs low because there's just not a lot of manual or active management that's required. They're not necessarily trying to beat the overall market. They're not trying to beat a section of the market. They're just trying to make a competent play in one segment via using an index to their investors and try to make that make sense. Now, the article said, Michelle, that it's a great building block.
Yes.
All right.
To the portfolio.
Well, and here's why it says that. It's been, the thing is, if you look at the stock market, we've talked about this. In general, in my opinion, the stock market can be very emotional in the short run, but over the long run, I'm a fundamentalist. I think fundamentals come back into play. I think that revenue matters and price per share. All these things matter in the long-term valuation. So if there's common sense that plays into that, as you look at the stock market, at least over the last 100 years, if you will, it's always gone up and to the right. All right. Now, it's gone up and to the right in a very roller coaster pattern at times. But when it's talking about being a building block, if you've got time to be in the market and you believe in the future of the stock market, if you will, then as long as you can weather the ups and downs, you're going to, generally speaking, continue to go up and to the right with your gains. Well, if you believe in that over a long term with your low-cost index funds, that means you're keeping the majority of your investment in your pocket, and you're not paying people to manage it. Again, for something that is usually done that's fairly not autopilot by any stretch. There's really intelligent people in this whole thing, but it's something that is the opposite of something where you're getting really heavily actively managed inside there. So yeah, in general, I agree with it. Now, do you want to be in all index funds when you're in retirement? Not really, because really a lot of times what you're trying to do is you're trying to accomplish different goals than maybe what just a broad-based index fund is looking for, especially one that is going to be looking at capital accumulation. So that's where the financial advisor and the financial planning stuff probably comes into play for value, is you can come in and help people pick, hey, yeah, we do use this actively managed fund. Yes, it is a little more expensive. Here's why. Here's how we use it. So very good. I like it. What you got next?
All right. So you have shared with me that the radio show tends to drive a lot of traffic to your website, which is wonderful. So keep it up, listeners.
That's right.
And I know you put a lot of time into an effort into making it useful and educational for your clients.
I do.
Anyone searching for straightforward financial guidance. So our next article is from your site.
That's right.
Voila!
Yeah.
And you must have felt pretty strong about it because you put it right there on your main page. It's titled, "We are fee-based financial advisors offering a wide variety of services." And I must say, based on the volume of services listed, you are not
joking.
Kidding. So I'm mentioning this article because I think it relates back to your discussion about value and what you started off with, and receiving services above and beyond just the investment management piece of a client relationship.
Right.
Do you want to tell us more?
Well, I do, obviously. And as Michelle said, yeah, it's right there on the main website. This is obviously a little self-serving, but this goes back to what we were talking about with value. So part of the reason I put it there, Michelle, is because, investors that have, let's say, done 401ks or 403bs, or maybe they've done the old broker world where they had just a brokerage account and, hey, I bought 100 shares of XYZ. Their broker calls and says, I'm thinking about doing 1,000 shares of this, that, and the other. The point of it is there's nothing wrong with that world. It's just sometimes the folks like that, investors like that, will try to translate that to what the financial advisor, the financial planning world does. And it's not like they're radically different. My line of work wouldn't existed if the road hadn't been paved by brokers, right?
Right.
But just like a farmer, if a farmer has somebody supplying them seed, that guy's got a very valuable job of picking the right seed at the right time.
Yep.
But we are more, how do you manage the entire farm? Is that a metaphor or is that a simile? Whatever that is, if that makes sense, right? We're going to look at more the irrigation. We're going to look more at what crops are in place.
Crop rotation.
There, now you're talking, right? So on my webpage, and yes, it is a little lengthy. I tend to go over the top. If you go to the homepage and you click on the PDF in the middle, it'll bring it up. We are fee-based financial advisors, offer a wide variety of services. As we just discussed a couple headlines ago, fee-based means that we do charge a fee for the asset management, an AUM fee. Now, typically what we'll do, sometimes, Michelle, depending again on the assets, depending on the needs of the client, sometimes there's a separate financial planning fee. Sometimes it's all lumped in together. We are not paint by numbers necessarily, but in our services, welcome orientation. That's one of the last things I added, but it's probably the most important, is when somebody transitions over, especially if they're coming out of a long-term relationship, which a lot of times they're coming out of a broker relationship. It's like going to high school for the first time. Where's the
college.
Bathrooms? Where's all that stuff, right?
Right.
So the welcome orientation is, how do you read the statements? Where do you find your accounts online? There's a lot of hand-holding that goes into the transition because this is all going to be new. Sometimes people come over with the same custodian. Charles Schwab is a very well-known custodian. We use them. Sometimes there's that learning curve's already been done, but more often than not, somebody's coming into a completely new situation. They don't even know where to log in, right?
Right.
Experience investment management. We do it by portfolio design. It's not all about, people say, my buddy bought this and it, got 100% return on blah, 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 blah. I'm like, that's great. That's not really, you're missing the point of what we do. This is more about overall financial planning, trying to get you where you're at now, GPS coordinates, what's the successful life for you, both professionally and personally, And how do we get there to you utilizing your assets and your investments and things like that? And also, like on some things, it's tax loss harvesting. Sometimes it's simple, or not simple, but it's the details inside that investment management. There's comprehensive financial planning, tax planning, income planning. I'm not an attorney, but we have Michelle that helps with wills, trusts, estates, final wills and testaments. We have in-house. We also have referral partners. Will Stye, who is an advisor in our firm, is a CPA, licensed CPA, has been for many years. Not tax preparation. That's your CPA's job. But we do tax planning. We coordinate with your CPA. You get where I'm going with this.
Yes.
There's a lot that's in these services. Right. And, there's an argument to be made. My life would probably be a lot easier if I just bought and sold positions. But I like looking at the overall picture. I like helping people put the puzzle of their life together. And quite honestly, I like when things are complicated.
Weirdo.
That's right. All right. What you got next?
Okay, it's our last one.
Oh, it is? Okay, good.
Yes.
All right.
And this one was from our friends at Smart Asset, which you got to be careful with as well.
Yeah.
So they asked the question, is it worth paying a financial advisor 1%? Now, at first thought, I would say yes, but then what are you paying for?
What are you paying for?
Right. So this article describes the basic differences between financial advisors and financial planners, which you kind of touched on. It also gives feedback to questions about what fee is considered too high for a financial advisor. And our show topic, can someone manage their money on their own? Who knows? From my experience on the show, I've learned that in general, a standard advisor fee for what is called AUM, Assets Under Management,
right,
is 1%. But what I don't understand is how the industry arrived at this number, except for it's just one. It's easy, I guess. And what services are typically involved? Does 1% always include financial planning? Is it a free coffee? Do you get a birthday gift every
Foot
year?
massage?
Or do they come and tuck you in? I'm not sure. But so what do you typically charge, and what services are included in that number? And I did read that the average financial advisor fee is 0.59 to 1.18%.
Okay. That's a wide range, actually.
It is.
Yeah. So a couple things here, and so we don't repeat ourselves with some of the stuff we just talked about with all the services. Where did the 1% come from? That I don't know.
Out of a hat.
I think it's probably a number that
it's easy math.
It's easy math, and if it wasn't too much pressure. And honestly, when you compare it to some of the sales commission / sales loads on some securities, 5%, 7%, and some particular products you're getting up in the 9, 10, 12%. 1% looks very reasonable, right? Also, too, the thing is, it's a reasonable number. It's intended to be a reasonable number that is charged year after year, because the services, as opposed to a transactional broker type relationship where it's, a lot of times it's going to be one and done, not always, but a lot of times this is intended to be an ongoing relationship where you're talking often. We set up where our clients, we have formal times to gather, but as anybody that is either called the show or been one of my clients will tell you, I'm talking to my clients a lot.
Yes.
And this is how I do it. Because I think communication at the end of the day,
it's actually his real cell phone number he gives you guys.
That's right. Yeah, because I want to know who's calling, which is crazy. They thought we were nuts, but it works. And sometimes when I forgot to tell you this, last Sunday, somebody called actually during the show, but I got back to him later. So anyway, the point being is, here's the point of this whole episode. You need to find out what you are paying. And again, we wanted to give you the terminology so that some of these things people in my industry use, whether they intend to or not, it can confuse people. You could say, well, you're paying 75 bips, and maybe that sounds high or maybe that sounds low to you. But if you have context to know that's 0.75%, and you know that the industry average for your amount of assets is maybe 1%, and you're getting a lot of services for that 75 bips, 0.75%, then maybe you feel a little bit better. Or again, if you take a look at some of your, I hate to pick on variable annuities, but they tend to be the most expensive products. But if you look at your VAs and you total it up, and 3.2% is 320 bips. That's a significant larger than what you could do. Forget the financial planning if you just went out and bought low-cost index funds. So there's all kinds of questions to ask. In the previous headline, I gave you all the things that we do for our asset charge. And again, that's on a case-by-case basis. We sit down with everybody, we see what the needs are, and then the main thing is we try to give you value for what you're bringing to the table. And I think I've said this on the show before, Michelle, I'm going to say it again. You don't have to bring huge assets to the table. That's not the point of this. We work with all sizes. It's really about trying to help good people get where they're going in their life. So very good. All right. Well, is that it?
That is it.
All right. Well, so great job with the headlines as always. These are always important pieces of information that impacts those in or near retirement. Now, listeners, if you have questions around the topics in our headlines of the week or questions related to your investment strategy or your financial plan, again, you can set an appointment by calling us at 251-327-2124, or you can go to our website, gulfcoastfa.com. Again, that's GULF, like the Gulf of Mexico, Coast, FAs and financialadvisor.com. Upper right-hand corner is a link to our calendar. Click that, set an appointment, or you can also send a message on the website, okay? And all those meetings, all the conversations are free. There's no pressure. There's no obligation, okay? All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong? How wrong? Have I ever been wrong, Michelle?
There have been some fails.
There's a couple, yeah. So what do I think is going to affect investors in the near future, maybe even the long-term future? We get to talk about all these things and poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FAs and financialadvisor.com. Welcome back. Your host, Josh Knoll here, alongside co-host Michelle Lee.
Howdy.
So I am opinionated. I do have strong opinions at times, and I would say a radio show host that isn't probably wouldn't be very interesting to listen to, right, Michelle?
That's right.
All right. So, and I am paid in my profession to offer professional guidance and opinions to my clients. Again, otherwise, what use would I be? So sometimes I feel so strongly about something that I talk about it publicly, on the various podcasts and radio shows I've had in the past. Sometimes I'll even make some predictions. And because I am skeptical, I feel like I'm usually proved right. But there are times I swing and miss. So if you want to hear me beat my chest or maybe eat a little crow, let's get at it with Josh's crystal ball and big mouth. What you got, Michelle?
Okay, you and several financial industry pundits and commentators once said that when the Department of Labor's fiduciary rule went into effect, it would have a huge effect in the financial service industry by forcing most commission-based brokers and insurance salespersons to switch to fee-based compensation or leave the business altogether. Bye now. So this Department of Labor, or DL for short, started this initiative way back in the Obama administration, which doesn't seem that far away, but I guess it is. And surprisingly, the Trump administration did not hinder the fiduciary rule going into effect. So fast forward to the present, it's finally making its way to being implemented during the current Biden administration. Or is it?
Right.
So it looks like various lawsuits have held it up. Sounds like some other things,
right,
with current news stating that the rule once called the definition of the term fiduciary, which sounds suspect anyway, because definitions are always open to interpretation. But anyway,
fair,
to now being rebranded as the, quote, conflict of interest and investment advice, unquote. That makes more sense to me.
Right.
We have conflicts of interest as attorneys and other things,
right,
so that's pretty. That makes more sense. So my question is, did your big mouth nail anything with your opinion? And more importantly, has anything changed at all?
Okay, so first, let's in broad terms, let's explain what this rule means. Back in the Obama administration, like Michelle mentioned a long time ago, they felt there was a lead up to making several changes with how advisors, brokers, salespeople dealt with generally qualified retirement accounts. What do I mean by that? Just think 401ks, 403bs, traditional IRAs, anything that gets a tax preferential treatment from the IRS is generally speaking a qualified account. They felt like there were several shenanigans going on in the industry, particularly when it came to rollovers of people coming out of low cost, call it at least professionally run 401k plans and going into higher cost investments in an IRA wrapper, going into higher cost insurance products, going into higher cost mutual funds, so on and so forth. And here's the thing. They weren't necessarily wrong. What they originally tried to do is make it kind of a backdoor way to get rid of some of the commissioned-based business that happens in the industry. And I say that, folks are like, well, what does that matter? What do you mean? Here's why they were trying to do it. Here's why it matters. What they were trying to do is say that any securities licensed person, and it didn't cover insurance, sadly enough, but any securities licensed person had to act in a fiduciary capacity when they were dealing with qualified plans of clients. What does fiduciary mean in general terms? It means that you put your client's best interests ahead of your own. Whereas in the old commission-based world, in the insurance product world, you just had to have a suitability standard, which means is the product that you're selling to the client suitable to their situation? It's a much lower bar to chin, right? Okay, so that's basically what the fiduciary world was going. When Trump came into office, there was a lot of anticipation in my industry that the fiduciary or the DOL fiduciary rule was just going to go away. Kibosh, right. They felt like he was going to squash it. And I don't know all the political mechanisms. I don't pay a whole lot of attention. I just know that for the most part, he didn't necessarily stand in its way. What did stand in its way was a lot of lawsuits. Well, fast forward to the Biden administration.
More lawsuits.
And they were set to get it re-released earlier this year, rebranded, like Michelle said, the conflict of interest and investment advice. And again, it got held up in lawsuits. Now, all that said, there has been absolutely some of this stuff that has trickled down. A big one and a small one. The big one is my industry is moving towards fee-for-service advice and has been for the last several years. The DOL just kind of put a little rocket fuel on that, if you will, but the whole industry is heading that way. That's where you're paid for your fee-for-service. That could be managing assets or putting a fee on assets under management. That could be charging a planning fee. That could be charging by the hour. Whatever it is, it's very transparent. There it is. There's what you pay. And it's intended to help the person understand what this investment advice is costing them, as opposed to the commission world, which, having been in the commission world before, it is confusing. I mean, heck, most of the time I didn't even know what I was getting paid. So it's hard to describe to somebody what you're getting paid when you don't even know. So what has happened is not only in a big sense, not only has the industry continued heading away from the broker world and the salesperson world to the fee-for-service advisor world, but also on a smaller sense, there has been various documents and legal requirements come into play, Michelle, where if you are rolling a 401k into an IRA, you've got to list out the existing 401k expenses, compare that to the expenses in the IRA, which generally speaking are going to be higher, and explain why the higher cost is worth it, all right? Okay. Yeah, for somebody who wants care, custody, and control of their IRA and wants professional financial advice and planning, then it makes sense, right? But if you're just a buy and hold investor, always have been, then maybe it doesn't make as much sense, and there's no reason for you to pay twice or sometimes 3 or 4 times as much for more or less the same investments. That's the point of all that. We'll see what happens. I'm not going to hold my breath. I don't have to worry about it as much because I am a fee-for-service advisor. Right. So I don't even have a broker-dealer relationship. Yoo-hoo. So, and it affects broker-dealers.
One less thing
to worry about. That's right. All right, what you got next?
So, Josh, on a previous Coasting and Retirement episode, we talked about the current potential danger of owning commercial real estate-based real estate investment trusts, or REITs for short. They come back. You stated that it was becoming more and more obvious that the work from home phenomenon of COVID was here to stay, plus the carrying costs of the loans on many investment properties were starting to skyrocket because of developers having to refinance into a much higher interest rate environment. Well, according to a recent article by Fortune magazine, quote, commercial real estate gets even bleaker with $64 billion in property now classified as distressed, end quote. That's sad. The article goes on to state that the amount of distressed assets rose 10% in the first 3 months of 2023. With the potential for another $155 billion of commercial property assets to become trouble this year. Obviously, your big mouth was proven correct here. But what does your crystal ball say about investors owning REITs that could hold a significant position in commercial real estate?
Okay, so a couple
Turn
different...
them into apartments.
a couple different tacks here. Yeah, I think, last I checked, I think residential and warehouse REITs are doing fine. So couple different things. One, in general, REITs are a useful tool that retirees will often use to help fund their retirement through the use of dividends. It's more complicated than this, but the basic thing is the REIT holds actual real property, or at least notes on property, something that generates some type of income. When that income is generated, it is distributed to the holders of the REITs in the form of dividends. That's a really broad explanation of how REITs work. And in general, they're fine. Second point, there's two broad type bases of REITs that Michelle and I have talked on a previous episode. I don't remember the episode number, but if you all will go to Spotify and
it was all about REITs.
It was all about REITs, and go to Coasting Retirement. You can find the REIT section. You can also go to the website, go to the podcast tab. But there's two broad types. There's publicly traded, and then there's what's called non-traded. Publicly traded are traded on an exchange. They are at least more liquid than a non-traded REIT, which is going to be more of a private type placement. And there's on the non-traded REIT, the distributor of the REIT has quite a bit more control over reimbursements. And more importantly, if that REIT goes down significantly in value, it's really hard to unload that REIT. Now, there are exchanges now that allow you to go on and unload non-traded REITs, but that's a very individual conversation to have with us at Gulf Coast Financial Advisors. All right, and then so lastly, the distress in the real estate. The question that you asked, Michelle, is, as somebody that's owned commercial real estate and owned several pieces of real estate in my past, I can tell you that when this kind of thing, it does look like a little canary in the coal mine, because I don't know what makes it better. There's probably going to be, everything goes in cycles. There's probably going to be a point where people are tired of working at home. Although you and I, at our age, how often do we remark, like, does anybody work anymore? It feels that way sometimes. Like, good Lord, where are all the young people?
I, for one, would not thrive working from home.
It would be, especially, between the two of us, we have 3 kids, and that would be hard for me to work at home too. So, and then more importantly, what just throws this all into a real issue, and like you said, the potential for another $155 billion is a lot of this real estate was bought up when interest rates were very low, when money was cheap, and now it's not.
That's right.
And they probably had numbers that made sense when interest rates were 2, 3, 4%. Now they're 7, 8, 9, 10 plus 12%. They got a problem. And I don't know how to solve it other than just to make sure that with my clients, we're looking carefully at the REITs they're holding and the REITs that we're looking at purchasing. And also if they're in something that's gotten banged up pretty bad, we look at if there's an effective way and it makes sense to get rid of it. So
all right. We'll call Josh about the REITs, and it was episode 12.
Well, not very nice. Episode 12, Coasting Retirement. I like it. Checks notes. All right. We done?
We're done.
Very good. Nice work. So, listeners, I hope you enjoyed a peek behind the curtain on how I form my opinions and my predictions. Right? Well, that's from the Roth conversions. And we got you alive now.
Yeah.
Yeah. And more importantly, that I'm willing to admit when I'm wrong, which hopefully isn't very often, but still. Now, to our listeners that have more questions about the various investments and topics that we discussed in this segment, or just want to talk about your own investments and your own financial planning or your tax planning, we invite you to reach out to us. Again, call anytime, 251-327-2124, or if you want to make an appointment on our website, go to gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast. FA is on financialadvisor.com. There is a Calendly link in the upper right-hand corner. You can click that, and that will allow you to set an appointment on my website, or on my calendar, pardon. So, folks, that's it for us here this week at Coasting Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton.
My pleasure.
Yes. Thank you to our awesome radio station, FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, local band Sloth Racer. And then lastly, and as important as any, always my sincere appreciation for all of you out there that have been listening and joining us on this journey. We would love to be a part of your financial journey as well. Until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and qualified plan advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.